Investing is often seen as a complex skill reserved for specialists, traders, or financial experts. Yet the foundation of successful investing rests on principles that are simple, timeless, and behavioral. The intelligent investor is not someone who predicts markets, identifies the next hot trend, or outsmarts billions of dollars of institutional capital. The intelligent investor is someone who makes rational decisions consistently, protects themselves from emotional mistakes, and understands the long-term nature of wealth building. The journey begins with accepting a fundamental truth. The stock market is a voting machine in the short run, but a weighing machine in the long run. This means market prices can be wildly inaccurate day to day, driven by fear, rumor, excitement, and speculation. But over long periods, markets tend to align with the real performance of businesses. Recognizing this difference protects investors from the noise that surrounds daily market movements. Most individuals do not lose money because they lack intelligence. They lose money because they lack discipline. They chase speculation, believing it is investment. They react emotionally to short-term volatility. They follow crowds during manias and panic during declines. Intelligent investing requires the opposite behavior: the ability to remain calm when others are frantic, cautious when others are greedy, and patient when others demand quick results. A foundational distinction in this philosophy lies between defensive investors and enterprising investors. Defensive investors prioritize safety, simplicity, and consistency. They choose diversified, low-cost strategies that require minimal effort. Their goal is not to outperform markets, but to avoid mistakes and preserve capital while slowly growing it. Enterprising investors, on the other hand, are willing to commit more time and analysis in search of better than average results. They examine businesses closely, study financials, evaluate management, and make decisions grounded in intrinsic value. Each approach is valid. The key is choosing the one that matches emotional temperament and personal discipline. Intrinsic value plays a central role in the intelligent investor's mindset. Intrinsic value refers to the true worth of a business based on assets, profits, growth, competitive position, and long-term potential. The market price, however, is simply what people are willing to pay today, which may or may not reflect reality. By anchoring investment decisions to intrinsic value rather than temporary price fluctuations, the intelligent investor avoids speculation and maintains clarity. When the market is overly optimistic, prices rise above intrinsic value. When the market is fearful, prices fall below intrinsic value. Intelligent investors act only when the relationship between price and value provides a margin of safety. The concept of margin of safety is a cornerstone of this entire framework. It means giving yourself enough room for error so that even if assumptions are imperfect, the investment remains sound. This could mean buying assets well below their estimated intrinsic value, diversifying across industries, limiting exposure to any single investment, or maintaining cash reserves. Margin of safety acknowledges that the future cannot be predicted precisely, and that humility is essential in financial decisions. One of the most powerful metaphors in the thinking of the intelligent investor is the fictional character Mr. Market. Mr. Market is your business partner who offers every day to buy your shares or sell you his. His moods swing wildly. Some days he is euphoric and offers high prices, and on other days he is depressed and offers low prices. Most investors allow Mr. Market's emotions to influence their own. The intelligent investor does not. They use Mr. Market's mood swings to their advantage, buying when pessimism creates opportunity, and ignoring him when enthusiasm inflates prices. This metaphor encourages detachment, patience, and rational decision-making. The intelligent investor also understands that volatility is not risk. Volatility is simply the natural fluctuation of prices. Risk, on the other hand, is the possibility of permanent loss. Many investors confuse the two, panicking when prices fluctuate, even though the underlying business may still be strong. Intelligent investors accept volatility as part of the investing landscape and instead focus on avoiding permanent loss through sound analysis, diversification, and margin of safety. Another important topic is the danger of forecasting. Economists, analysts, and market commentators frequently attempt to predict future prices, interest rates, and economic conditions. Yet history shows such forecasts are rarely accurate. Intelligent investors do not rely on predictions. They rely on principles: valuation, discipline, resilience, and long-term perspective. It is far safer to prepare for a range of outcomes than to assume a single scenario will unfold. Long-term thinking is central to this philosophy. Markets reward those who endure, not those who react. Compounding, the engine of wealth creation, requires time and consistency. Even modest returns compound into significant sums if left uninterrupted. But when investors constantly buy and sell, chasing momentum or reacting emotionally, they interrupt compounding and weaken results. The intelligent investor protects the compounding process by avoiding unnecessary trading, maintaining a stable strategy, and resisting emotional impulses. The relationship between inflation and investing is also critical. Inflation silently reduces the purchasing power of money. Holding large amounts of cash may feel safe, but it leads to guaranteed loss over time. Productive assets such as stocks, real estate, or well-managed businesses generally outpace inflation and preserve wealth in real terms. Intelligent investors consider inflation when constructing portfolios, ensuring that returns exceed the rising cost of living. Diversification is another cornerstone of resilient investing. Even the most carefully researched investment carries uncertainty. Diversification reduces the impact of being wrong, but diversification should be intentional rather than excessive. Owning too many stocks leads to confusion and dilution of analysis. The intelligent investor diversifies across industries, asset types, and risk levels, enough to mitigate risk, but not so much that decisions lose clarity. Costs matter as well. High fees, frequent trading, and unnecessary management expenses erode returns significantly over time. Intelligent investors are cost conscious. They understand that minimizing costs is one of the simplest and most reliable ways to improve long-term results. This is why broad market index funds are often recommended for defensive investors. They offer low-cost, broad diversification, and consistent exposure to economic growth. Another theme is the role of psychological discipline. Overconfidence often leads investors to believe they can outperform markets easily. This mindset results in excessive risk-taking, concentrated bets, or speculative behavior. Conversely, fear can cause investors to sell at the worst possible moments. The intelligent investor cultivates emotional balance. They develop the ability to act with rationality, even when others are guided by emotion. Intelligent investing also involves understanding personal circumstances. A strategy appropriate for one person may be entirely unsuitable for another. For example, a young investor with decades ahead may afford to take more risk, while someone approaching retirement may prioritize stability. Income level, job security, family responsibilities, and long-term goals all influence what constitutes a sensible investment plan. Intelligent investors design strategies tailored to their own financial realities, rather than copying others. One of the most valuable skills is the ability to ignore noise. Financial media thrives on drama, sensational headlines, market predictions, breaking news, and exaggerated threats. These constant distractions cause unnecessary anxiety and push people toward impulsive decisions. Intelligent investors filter information carefully. They focus on fundamentals, not headlines. They listen to data, not emotion. Patience is another powerful characteristic. Most investors seek quick results, but markets reward those who wait. Businesses need time to grow. Strategies need time to develop. Compounding requires time to accelerate. Intelligent investors understand that time, when combined with consistent decisions, becomes a force working in their favor. Another important dimension is ethical investing. Intelligent investors behave responsibly, recognizing that companies must create value for society, not just shareholders. A business built on exploitation, dishonesty, or unsustainable practices may produce short-term gains, but eventually collapses under ethical or legal pressure. Long-term investing, therefore, involves evaluating not only financial metrics, but also business integrity and long-term viability. A final insight is that intelligent investing is ultimately about building a stable, secure, and confident financial life. It is not about beating the market, impressing others, or engaging in financial competition. True investment success means being able to live without fear of economic uncertainty, without stress from daily fluctuations, and without dependence on prediction or luck. It means controlling your emotions, protecting your capital, and allowing rational strategy to guide decisions. This philosophy encourages investors to be patient, disciplined, humble, and thoughtful, to remain calm during fear, cautious during excitement, and always grounded in long-term thinking. Investing becomes not a pursuit of excitement, but a deliberate path toward independence, resilience, and lasting wealth. And in that steady, intentional journey lies the true strength of the intelligent investor.